Absolutely delighted to have Ron Muhlenkamp here with us today. He's the founder of Muhlenkamp and Company, established in 1977 to manage private accounts for individuals and institutions. He's the majority shareholder of Muhlenkamp and Company and serves as the firm's chairman of the board and internal economist. His work since 1968 has been focused on extensive studies of investment management philosophies, both fundamental and technical. As a result of this research, he developed a proprietary method of evaluating both equity and fixed income securities, which continues to be employed by Muhlenkamp and Company. In addition to contributing to Muhlenkamp and Company's quarterly newsletter, Muhlenkamp Memorandum, Mr. Muhlenkamp is also the author of Ron's Road to Wealth: Insights for the Curious Investor. He received a bachelor's in mechanical engineering from MIT and an MBA from Harvard Business School. Thank you for joining us today, Ron.
Pleasure to be here, Itai. Good to see you.
Excellent. Great to see you as well. So let's begin.
Well, as you said, I began this in 1968, which frankly looks a whole lot like today. In 1968, everybody believed that the U.S. economy grew at 4 or 5% a year, that 4.5 is normal interest rate on the long bond, and this stock sold for 17 times earnings. That was a given. Well, by 1971, 2, 3, it was apparent that that wasn't working anymore. So I started looking at, coincidentally, the 60s was the beginning of the belief that maybe you should look at growth stocks. Prior to that, stock dividends yielded more than interest rates because stocks were less reliable. They weren't guaranteed, bonds were. So stocks were simply owned for the dividends. And the idea, and this cropped up with people like Irving Fisher and T. Rowe Price, the man who founded the firm, to look at stocks that were growing, and you would bet on the come on growth going forward. Nevertheless, average PEs were 17, and everybody took that as a given. Well, in 1970, inflation ran up, and everybody said it was temporary, not transient, but temporary. And then they came back down. Well, by 1973 and 4, inflation ran up, and everybody said, my God, it could be permanent. And then interest rates ran up, and stock prices came down. And I was working for an insurance company at the time, and analysts would say, well, everybody knows 17 is a normal PE. PEs are down to 14. You should buy them. And a few months later, they come by and say, PEs are at 11. They're cheap. You should buy them. I said, wait a minute, I'm out of money. You know, what's going on here? They keep getting cheaper. So I started asking everybody I could think of that had thrown everything they could think of into the computer and said regress, looking for parameters that you could rely on. Now, I've had a total of 2 courses in economics. And fortunately, it was only 2 courses because within 10 years, it was all disproven in the 70s and again in the 80s. I've never had a course in Wall Street finance. I studied corporate finance. What I understood coming out of engineering was production. So what I studied at Harvard Business School was marketing, finance, and labor relations, but I never studied corporate finance. So I will tell you, learning is easy. Unlearning is hard. When the things you've been taught and you believe no longer work, it's much, in order to break out of those thought patterns, it'll help you a whole lot if you find new language. And for instance, when I got at that time, many businesses invested money on a what they called payback. How long will it take us to get our money back? What we were taught at the business school was discounted cash flow, and in between there was a return on shareholder equity. So what I met with in business was some payback, some return on equity, and when I tried to introduce ideas like discounted cash flow, it took 30 years later, when my compatriots were running companies, that became the standard. But it's hard for people to unlearn what they've learned, particularly if it's been successful. But it's necessary, particularly if it's been unsuccessful. But anyway, so I started asking folks what the computer spit out, and it was spitting out book price to book versus return on shareholder equity. Well, in corporate finance, when we looked at buying a company, those were parameters that we used. And I'm now going to start a PowerPoint presentation, which are charts that I used in a paper I wrote back then that I've never published. It's on file with the Copyright Commission, but frankly, it gave me an edge for 30 years. So this will be the first time that I've really put these out in the public, and I'll walk you through them. They're also on our website if people want to go back and look later, and of course they can do this later, but it goes like this. Okay, one of the people that sent me data that had looked at all this data and sent it to me was William D. Witter. And it's a little faint on here, but this data I got from William D. Witter. It's price to book versus return on equity. The 100 industry groups in the S&P for the period 59 to 71. And you'll see dots up here. Okay, it's a big scatter diagram. Okay, and they drew a straight line through it. Well, I have two problems with that straight line. One is if you continued on down to zero ROE, it crosses the left axis at a minus 1.1 times book. I didn't think that made a lot of sense. And it also, now, price to book of 1, we have a lot of theory and practice on. Price to book of 1 is where companies buy trucks, where they build plants, okay? And historically, what we believed was if inflation is 3%, bond rates ought to be 6, and maybe you had to earn 9 to be worthwhile putting up equity capital. Well, this crosses the price to book at 1 at 7.1 or 2, something like that. And in 1973, when inflation was in fact looking at 6 and interest rates were on 9, it made no sense to pay book for a 7% return on equity. So I've got those two problems, well, actually 3 problems with it. 1 is the intercept, 2 is the shape of the curve, and 3 is the price to book of 1. Well, it looks to me like a curve would fit this better than a straight line, just visually. And of course, you probably know that anything that's a straight line is man-made. God made no straight lines. If you're in an airplane and you look down at the earth, any straight line is man-made. So I asked the computer, I put in the same data and asked it to fit a exponential curve. After all, if you're discounting the future, it ought to be exponential. But at the time I could do logarithms. It would be tough for me to do that now, but I also did a quadratic, a plus bx curve. And I did that, and the computer fitted these lines to the same data. So this is the same data, same plot, but with an exponential curve and a quadratic curve. And both of them cross a 0 return on equity line at about a 0.3 or a 0.35. And the computer said they were both better fits to the curve than the straight line was, okay? So maybe the world is not linear. Well, but we still had this problem that they're crossing the price to book of 1 at a 7 point something. And that made no sense in 1973. So I said, well, what if inflation is 7%, we considered normal for the long bond to be 3% above inflation. Now, in the last few years, some economists have said 2%, but what they're really, I think, saying is that the nominal return on bonds should be inflation plus the growth rate of GDP. And at that time, we had a 3% growth rate in GDP. Actually, it was 1% population, 2% productivity. The GDP grew by 3%, is where that bond premium, the interest rate premium came from. So then I'm playing with what should the equity premium be? Should it be a constant premium? Should it be a ratio? And I played with 3% and 1.3 and things like that. And incidentally, yours can be different than mine. I've since used this in talking to clients to try to determine what their equity premium is versus, and I'm just taking mine from historical numbers. But the long and short of it is, I said, if inflation is 7%, 7%, interest rates ought to be 10, and I need a 13% return on equity to be willing to pay book. What does the intercept down here do? If it's at 0.3, it probably doesn't go up. It shouldn't go below 0. And if you assume it doesn't, so it's around 0.3 plus or minus 0.1, which really doesn't matter very much. So then I engineered a curve to pass through this 0.3 and a point down here at 13%, and I get this curve. So that's my proposed curve for inflation at 7%, okay? And the formula for that curve is in the upper left here. It's simply price to book equals A, which is a constant, depending on inflation, times ROE squared plus, this says 0.35, I usually use 0.3, okay? So now I have a theory. Well, I have a curve that fits historical data, and I have a theory of where it should be. Well, of course, if you've got two curves, you've got a family of curves. The family of curves looks like this, okay? And incidentally, PE is just price to book times earning ROE. ROE is simply earnings over book. So you can convert back and forth, and this is the formula for the curve. And then this is the curves that I get for 0% inflation, 1, 2, all 0 through 10. Okay, so now I have a theory. I have a theory on the title of all this is a structure for evaluating common stocks. And this is my theoretical structure. So I said, okay, if it's valid, it should have worked in the past. How do I test it against the past? Well, I went into Graham and Dodd, which I think you folks are probably familiar with. I believe I had the 62 edition. And on pages, Graham and Dodd, page 538, he proposed that the BE should be 8.5 plus 2 times the growth rate. And if you convert PEs to price to book, you get this curve, which is almost coincident with my 1% inflation curve. Okay? And he had a second one he called the preferred method on page 537. It falls between my 1 and 2% inflation curves. Incidentally, in the 50 edition of Graham and Dodd, Ben Graham proposed a way of valuing stocks. And in the 60 edition, he upped his criteria by 50% without explanation. It was just mentioned in a footnote that he had upped his criteria. Well, as we'll see in a little bit, in 1950, inflation was 7%, and stocks sold at 10 PE. Incidentally, in 75, I got a long-term chart book, 25 years, and I'm just paging through. And what it looked like was stocks all started at a 10 PE, and by 75 came back to a 10 PE. Okay. Well, as it happens, in 1950 we had 7% inflation, and 75, 6, 7, 8 we had numbers well above that. But anyway, so I get the similar values that Ben Graham does. Remember, my data was from 59 to 71, as he did back then. Well, what happened I believe this is early 73, I can't quite swear to that, but Ben Graham himself proposed a model that said PE should be 37.5 plus 8.8 times the growth rate all over the AAA bond rate. And if you crank that out to price to book, this would be a set of curves based on bond rates of 3 to 13%. Remember, my curves were 0 to 10% inflation. This is 3 to 13% bond rates. And this is Ben Graham's theoretical curve. And I said, who am I to argue with Ben Graham? Well, by the end of 74, this is now data taken from Business Week's edition of March 24, 1975, prices as of February 28, earnings ROEs as of 1974. And this is the scatter diagram. And notice I took graph 3, put the scatter diagram on there. Well, if you had to fit a curve to that data, my 7% curve looks pretty good. At which point I said, okay, I'll argue with Ben Graham on this topic. So and incidentally, this is things like drug stocks and maybe Avon products and things like that. Well, by now, this says that to be worth book, you had to earn a 13% return on equity. You guys won't know this, but in the 70s and 80s, Business Week published a quarterly survey of corporate performance. It was very timely data. It was shortly after the end of the quarter, usually within a few weeks. They would give return on equity and PEs for a large number of stocks, grouped by industry group. Now, the data wasn't quite consistent because if you reported early one quarter and a couple of weeks later the next quarter, you might not be in the data the second quarter, but it was timely as hell. And if you organize it by industry group, you could literally plot these. And what we saw was the companies down here that were earning 6, 7, 8% return on equity, people like tire companies, people like steel companies, were closing plants. Because if interest rates are 10% and you're earning 8, you can't justify being in the business that you're in. And so these companies are all closing plants. Now, the folks out here at a 20% return on equity never had that problem, but they did have the problem of their price to book going from 6 times earnings to 3 times earnings. They still got cut in half. And of course, as you see the spread on this, when you discount the future, the farther out you go, the bigger the spread you get. You know that. And of course, and as I say, I got into business in '68. The S&P peaked in '68, and then from '68 to '72, the small stuff came down until we were down to the Nifty 50, which were stocks that people, or companies and stocks that people thought was growing at 15%. Well, if they're growing at 15% and you're discounting at 7 or 8 or 9, you can justify any price simply by going out longer. Well, and again, I was working for an insurance company, and shortly after I got to this stage in this work, an analyst came to town who followed Coca-Cola, which is of course out of Atlanta, and Coke had come down from 130 to 90, and he said the stock's worth 120. And I spent 30 seconds, ran through my calculation, and I said, gee, on my stuff, it looks like it's worth 35. That kind of ended the conversation. And a couple of weeks later, I was in Atlanta talking to Gene Caldwell, the founder of Montag and Caldwell. They'd made their reputation and a whole lot of money investing in growth stocks. He told me that if an analyst came to town and wanted to talk about something other than the growth stocks, his young portfolio managers would walk out of the room. I said, how are you dealing with the fact that it looks like inflation interest rates are going up? He said, we've had to up our discount rate from 9% to 15%. I said, what value do you get for Coca-Cola? He says, $40 a share. Well, if it's at 90, I don't care whether the number is 35 or 40. The point is, I'm not interested in owning that. But that's the kind of rationale that was going on at the time. Now, as companies figured out that they had to earn a 13, or incidentally, forecasting growth is a very unreliable. I haven't seen anybody who's been able to do it with any kind of consistency over any great period of time. Return on equity has been 13% plus or minus 1.5% since World War II. It's been an amazingly stable number, and we'll come back to that in a little bit. But during this time, companies were deciding that they had to earn a 15% return on equity instead of an 8 or 9 or 12 or 13. But it takes them a while to do it. Well, the market can reprice assets once you get down to a 7 PE, which would be a 15% return on equity, and times 7 gives you 1 price to book. Once you get down there, the rest of the 70s stocks earned a 15% return. But to get there, you had to cut the price in half in 18 months, which was the great bear market of 73, 74. So what I'm saying is the aggressively priced small stuff without earnings, the 68 version of mem stocks came down between 68 and 70. The Nifty 50 came down from 72 to 74. And on one occasion, I forget which one it was, it might have been Avon Products, had a down quarter, and they killed the whole group of the Nifty 50. And my boss says, they stubbed their toe. I says, well, maybe Avon stubbed its toe because it had a down quarter, but the shareholder broke both legs. And nobody complained when they all went up together, but they complained like the dickens when they all came down together. Well, the argument was they'll never have a down quarter. Once you broke that faith, there was nothing below it. And things fell from here to here. Okay. So I've been using that ever since. So if you look at, where are we? Here, okay. Now, last week, I ran through, in this case, I used Value Line database. They've got, I believe it's 97 industry groups. Each plot on here is an industry group. If you draw what curve did I draw through here? It crossed price to book at, what do we got? 8%, 8 or 9%. So it's about the 3 or 4% inflation curve. And when I look at this curve and this diagram, I think of Leon Cooperman. You've heard Leon say that there's 3 groups of stocks out there. There's normally priced stocks. There's the FANGs up here with high growth and high PE, and then there's all the MEM stocks. Well, if I think this is normal and sustainable, I want to shop for buys down here. Incidentally, these are energy stocks and home builder stocks. The 8 or 9% returns are banks and insurance companies. The meme stocks are all up here. In fact, there's a few up here. And of course, any that doesn't have earnings is not on here. So if I'm looking for shorts, I'm looking up here, which we don't do a lot of. Well, if I'm looking for longs, I'm looking down here. But the real question is, today, I made a mark on here at 6% for inflation. Well, it's more like 7.5 in the latest numbers. Treasuries are down here at 2, right? The long treasury. I got a note today that says the junk bonds are trading below 6. So the first thing we have here is that, do I price it off of inflation or do I price it off of interest rates? Now, the models that people have been using for the last 30 years, the dividend discount models for stocks are priced off of interest rates on the assumption that interest rates are always fairly priced. Well, they weren't in the 70s and they weren't in the 80s. In the 70s, interest rates were much too low relative to inflation, which is what drove interest rates up. In the 80s, interest rates were much too high relative to inflation. At one point, the average company was doing a 13% return on equity selling at book. Corporate bonds were a 13% return on equity selling at book. So I have my choice of getting 13% nominal from either stocks or bonds. But if I'm a corporate treasurer, there's no way in hell I'm going to borrow at 13 to invest at 13. So I concluded either interest rates had to come down or corporate return on equity had to go up, or no company is going to borrow money to build plant and equipment. And I think there should be an equity premium. I'm still not sure what it should be, but there should be one. So if I can get 13 on a bond or 13 on a stock, I'll buy bonds. From 83 or so to about 94, we were a third in bonds. Now, I didn't buy corporates because they're all callable. For our tax-paying clients, we bought every A-rated or better 7% 30-year bond with 25 years yet to go at 50 cents on the dollar we could find. So I'm buying 7% munis, non-call. They were callable, but at par. I'm getting them for 50 or 55 cents on the dollar. Easiest money I ever made anybody. But we were getting 18 to 20% returns, much of it at capital gain rates, and the rest of it at no income tax rates. And of course, those days are gone. But today, my question is, and I don't have an answer, if we can make our assumptions about inflation, interest rates are not reflecting that, which is why companies, we'll get with what I want to know is what drives the consumer. If you can tell me what the consumer is going to do, the rest of this job is pretty easy. But I also want to know what criteria corporate management is using for their capital allocation. Our favorite question to corporate management, number one, is what analysts do a good job on your company? Number two is, what criteria do you use for allocating your own capital? Is it payback? Is it return on equity? Is it discounted cash flow? Is it earnings growth? I want to know what they're looking at, because they're not likely to hit the targets they don't shoot for. If it's a return on equity and they tell me their goal is 10%, I'm not interested. It's not worthwhile. My third question is, at what point on that metric do your guys start earning a bonus? Well, if they tell me that at 15% return on equity, they earn a decent, a bit of a bonus. But if it gets to 18, 19, 20, they get rich. Man, I'm interested. Their goals are high enough. I know what they're shooting for. If I can get in at a price, incidentally, anytime you buy a stock at book value, you're looking at the same base that they are. So they take care of you automatically. If you pay 3 or 4 times book, they've got to consistently earn a premium for you to pay that premium. Am I making any sense? So, but on price to book of 1 down here, you can plot inflation, you can plot interest rates, you can plot return on equity capital, but you're looking at things pretty much the same as corporate management does. Most corporate management has stock options. Do you know any of that have bond options? It'd be a contradiction in terms. The job of corporate management is to minimize the return to the bondholder. and maximize the return to the stockholder. And in the 80s, when people were refinancing their mortgage at lower rates, corporations were refinancing their debt at lower rates. Actually, prior to 1970, there was very little call protection on bonds. Interest rates ran up in 70, they came down in 72. I'm working in an insurance company. Arch Allen has a desk 10 feet from mine. He was running bond money. I was running stock money. He came in one day and he says, the sons of guns. He says, I'll sue the bastards. I says, what's going on? He says, these bonds that we bought 2 years ago at I don't know, pick a number, an 8% interest rates, they're calling them in because they can refinance at 6. I said, Arch, sue them if you must, but if they don't call them in, I'm going to sue them because I own the stock in those companies. Their job is to minimize the return to the bondholder, maximize return to the shareholder. Most of the time, we prefer to own stocks because we want management working for us, not against us. Nevertheless, in the early 80s, when we were given what we thought was very good returns on bonds, we ended up being a third in bonds for a decade or so. Today, we own none because when we look at, if the return on equity is worth book at a 9 times return, and junk bonds are selling yielding less than 6, I'm not interested. Okay, but this format, this layout allows you to do one at another. And all through the 70s and the 80s, every quarter with business weeks, I would put this plot out here, and you could literally see the low income returns. You notice today there's nothing below a 7%, except of course all these companies that don't earn any money at all. But I'm using industry data, which of course averages an industry, but it gives you enough data points to be meaningful without getting too lost in the weeds. So we've been using that for a long time. And the question today is, one is, what is inflation going to be? We know there's an awful lot of money out there. Incidentally, Ray Dalio had an interesting piece yesterday. If you haven't been monitoring him, I suggest that you do that. He had an interesting piece yesterday as to when printing money causes inflation and when it doesn't. And we might talk about some of that in a moment. But this is what the current spreadsheet looks like. And we're not done taking this out. My guess is it'll be a period of time, and the FANGs will hold on a little longer than some of the others. But for instance, year to date, I think the S&P is down, 6%? NASDAQ is down 10. So far, we're up 1 because we're owning stuff over in here. I own gold for the first time in my career. We've been playing games. One of the questions you sometimes ask people, one is the owning bonds versus owning stocks, and whichever one looks good, whichever one gives me a premium return. Incidentally, the idea that stocks are appropriately priced relative to bonds assumes that you're going to earn that equity premium. So if bonds are fairly priced and stocks are fairly priced, and the equity premium historically has been 3%, it means you're going to earn more, 3% a year more with stocks than with bonds. And we don't buy that volatility is a major risk. Volatility is a risk. We think there's a far bigger risk in paying too much. And frankly, if I were going for what Wall Street calls risk-adjusted returns, I would be invested from October to April and then in cash from April to October, right? The only trouble is I'm paying short-term capital gains taxes on any money I make. Really, what the history says is that from April to October, things move sideways. Well, if I can move sideways for 6 months and cut my tax bill in half, I'm much more interested in after-tax returns than I am in what Wall Street calls risk-adjusted returns. The early papers written on volatility called it volatility. Nobody cared. Nobody cares about volatility, at least particularly volatility up. So somebody went through, and I swear they just crossed out the word volatility and wrote in risk and defined risk as volatility. Well, everybody cares about risk. So all of a sudden people were reading the papers, which they hadn't bothered reading before. But we're interested in tax adjusted after tax return, after tax and after inflation. I don't know how far you've gotten into my book, but there's a beautiful chart in there going back to about 1929 showing that past book savings earned you 3% a year and bonds earned you 5% a year and stocks earned you 8 or 9. But if you take out inflation, past book savings are minus, bonds are plus a little bit, and stocks did 4 better than the others. So the only way in, what's that now, 30, 90 years that you made any money, that there was a period of time from 80 to today when the bond market had a bull market. Incidentally, in 1950, we had 7% inflation, but we had interest rates of about 3%. We had because we had interest rate controls coming out of World War II. But we also had a populace. My dad was born in 1910. My mom was born in 1918. The defining economic event of their lifetime was the Great Depression. If you lived through the Great Depression, and in 1951, the assumption was that there was a depression after World War I, there would be one after World War II. Well, in a depression, you don't worry about the return on your money, you worry about the return of your money. As long as our mothers and grandmothers feared the depression more than they feared inflation, they kept their money in passbook savings at 5.25%, highest rate allowed by law. And companies could borrow, or farmers could borrow, or mortgagees could borrow well below inflation all through the 70s. After a decade of that, our grandmothers started fearing inflation more than they feared depression. Merrill Lynch came out with a money market fund that paid 13%. They pulled all their money out. It took them a while, but pulled all their money out of 5.25% passbook savings and bankrupted the S&L industry. Because after a decade of inflation, it scared them into that. Today, we don't think it'll take as long for people to respond to higher inflation numbers now as it did then, because we have actually 2 generations later, we have very different experiences and therefore different fears and hopes than my parents did in 1950. I believe that one of the reasons there have been about 3 times since the 68 when the macroeconomists totally missed it. One is when inflation ran up, another is when inflation ran down. I missed it in coming out of 08. But if you have a population with a different set of experiences, don't be surprised if they act differently to what looked like the same criteria as a prior generation did. And once upon a time, I spent some time reading on long-term cycles, starting with Kondratiev. The guy who's done the best work lately is Ray Dalio. I encourage you to read up on his stuff. Okay, so what's that do for us? This is a plot of U.S. non-financial domestic corporate profit margin going back to 1970. And what's fascinating here, the highest numbers were in the Obama years. When it got up here, you probably know Jeremy Grantham, who said they'll return to the mean. And for a decade, Jeremy Grantham was expecting profit margins to drop down, I suppose, to something on the 11 or 12%. Pick a mean in here. Mean doesn't mean much. The average here is one thing, the average here is another. Here you could draw a slope here. Have you noticed that a half a cycle and a trend look an awful lot alike? And and you have to look beyond at least one cycle to find out what things are. But if you look at this, you say, gee, there's a trend. You look at this, you say, gee, there's a trend. Jeremy Grantham for a decade expected profit margins to come down. I did too. We'll cover that in a second. And 10 years later, he says that it hadn't happened. I was wrong. There's a couple other things we put on here. Oh, and so this is employment cost. Those of you that are working in January, February, you're going to get your W-2 from the company you're working for that will say what your nominal wage is, how much went to Social Security, how much went to various other things, and what your take-home pay is. And the average reported income for the American public in 96 was $36,000, by 06 was 40, and by 19 was 48, and these were the take-homes. Well, we put out a sheet of paper to our employees to tell them what the nominal was. Well, we're paying for Social Security and for health insurance, and so the cost to the company, and his health insurance went from $4,000 a family to 19. So the 36 that they were taking home 28 was costing us 43, which means, incidentally, my 3 of my offspring were working for me at the time, but for them to take home $1 cost me $1.53. And if we managed to fund pension or profit sharing, it turned out to be $1.86. Well, that $1.53 went to $1.84, and the $1.86 went to $2.15. For them to take home $1 cost me $2. So when people say the take home hasn't gone up, that don't mean the cost to the employer hasn't gone up. And that big spread, now that spread is taxes and health insurance, basically. But this is what it looks like to your employer. This is what it looks like to you. Incidentally, Thomas Sowell points out that if you look at things on a per household basis, they look very different than on a per capita basis, which is absolutely true. And I believe you probably know that the GDP in Japan really hasn't increased for 30 years. Economists all want to look at GDP. Well, to the public, during the 08, particularly in the 08, 06 to 16 period, when the economy was growing at 2%, population was growing at 1%. Well, if there's only a 1% spread there, a whole lot of people, and if there's a bit of a growth in that wedge, what people really are concerned about is GDP per capita. Well, in Japan, their population is shrinking. So even if GDP changes by 0, the per capita is a plus. And I think when the GDP per capita is growing, people are much more satisfied when they perceive it as shrinking. And of course, they're looking at GDP after taxes and after inflation on a per capita basis. What I learned in the 70s was when inflation was 10% and people get a 10% raise, bring their check home, and the spouse says, I can't buy groceries. Well, the next time you look at an income tax table, you'll notice that if your income goes up by 10%, your taxes go up by 20%. So even if you're keeping up with inflation pre-tax, you're not keeping up after tax. What was the fastest growing city in the country in the 2000 decade? What was the fastest growing city in the 80s decade? What was the fastest growing city in the country in the 70s? In the 70s and 2000s, taxes were going up faster than GDP, and the fastest growing city in the country was Washington, D.C. In the 80s and the 90s, incomes were growing faster than GDP, and the fastest growing city in the country was Las Vegas. Some of you have seen this plot, which is absolutely fascinating to me. This is a share of U.S. households using specific technologies from 1860 to 2019. And you can play with this on, what's this word, our world and data. But prior to 1900, pretty much none of this happened. My family got indoor plumbing in 1950, which is no great shakes, except the 50th percentile home in the United States got indoor plumbing in 1950. Now, to you, that's ancient history. To me, I'm 6 years old. That was a big deal. But all the things that made our life easier back then is all this stuff. The smartphone came out in 07. My grandkids think it's always been there. I've got 5 grandkids in college, 4 or beyond that age, another, what's that leave? 4, 5, 9, another 4, not yet there. But the smartphone has gone from 0% participation in 07. There are now 6.3 billion smartphones in the world with a population of 7.8 billion people. So about 75%, some people have 2, but about 75% of our people have a smartphone in 14 years. And yet, I'm sure most 20-year-olds consider that a normal part of life. No, that's abnormal as hell. My folks didn't get a telephone until I was in college. We went from cutting wood for heat. They got electric heat when I was in college. I think they lost some labor somewhere in there. And of course, what we all want to do is we want to invest in things back here when they're just beginning to be adopted but we only want to invest on those that are successful. We don't want to invest in all the things that prove to be non-successful through here. And what's not on here is if you look at electric cars, they've been trending on here between 0 and 1% since forever until the last few years, and they've now ticked up a little bit. So if you bet on electric cars back here in 1900, your grandchildren are working for a living. One other thing I wanted to put on here, what time are we getting to?
6:52.
Okay, we're chewing up an hour pretty quick. This is data I've been carrying around for 35 years, and one of the gals here suggested doing it in a pie chart, and I'll let you peruse this at your leisure, but I'll just hit a couple of highlights. This is U.S. personal consumption expenditures per capita, 1950, 80, and 2010 in real dollars, so it's all adjusted for inflation. And what this says is we're 3 times as prosperous. Our total spending per capita in 2010 was 32,000 per capita, up from 11. We're 3 times as prosperous as our grandparents were in 1950. What we spend on food has gone from 3,200 to 40. Food has gone up, but I can't eat 3 times what my grandfather did. So the percentage spent on food has gone from 29 to 14. It's been cut in half. Clothing has gone from 10% to 3%. Clothes are damn near free. Last pair of jeans I bought cost me $9. Housing went from 13% to 20. Between 50 and 60, price of housing went up a little bit. The big difference is houses are 3 times the size. In the 50s, houses were 800 square feet. In the 60s, it went to 12 and then 15. By 2010, they were about 2,400 square feet. The houses are 3 times the size. Healthcare went from 3% to 17. You'll notice I'm just marching down Maslow's hierarchy of needs: food, clothing, shelter, healthcare. The sum of those 4 has been between 52 and 54% all through here.
Yeah, absolutely. And what is your views on the home building sector today? And related holding that you have is NMI Holding. So can you detail your thesis for that, please?
Well, yes, we own 2 home builders and we own a mortgage company. I made a whole lot of money in home builders in the 90s. Yes, we bought them because they were cheap. The question today is, and now in what people learned in 08 was that house prices can go down. And remember at the time, the belief was they didn't, simply because they hadn't. And again, it looked like a trend, but it was half a cycle. Well, the question today is, will millennials marry and have families? And if they do, will they buy houses? And they've been hit a little bit lately because interest rates are starting to move up. I don't think interest rates have moved up enough to bite. There's a couple of things happen. I'm a value player, and my Bible is Ben Graham, Graham, and Dodd. Some people are trend players. In my opinion, if you were good at fashions in high school, that is, if you're quick to catch on to something that's trending in and out, you might be good at fashions in the stock market. I'm not. But I do think that both have value. But if you're coming off a bottom, you can move up a certain amount before it starts to bite. I mean, a 3% mortgage rate doesn't hurt anybody. If mortgage rates move to 4 or 5, if you want to buy a house, you might buy a little smaller house, but you go to the broker and say, I can afford $500, whatever the number, $1,000 a month, and that will determine what kind of house you can buy. And you decide whether with your family you want to own that house or live in an apartment, which is, the apartment's usually smaller. But anyway, that will depend on the reaction of the millennials to the numbers in housing. You saw on my scatter diagram that over here, the housing is earning 14 to 16% return on equity, maybe a little more, selling at 1.3 or 4 times book. Historically, they've traded between book and 2 times. NVR has broken out of that pack because they adopted a different strategy 30 years ago, and they've become a thing onto their own. But whether or not we're successful in housing, in my opinion, will depend on whether millennials buy houses or not. Now, another thing going on, what we didn't mention, along with these charts on our website, there's a few things that we've written over the years. Something that we think is affecting the current marketplace is I've been monitoring pension funds for 40 years. CalPERS, California Public Employees Retirement System, now has $500 billion. Pension funds in the US are something on the order of 12 trillion. There's another probably 2 trillion underfunded. Well, pension funds tend to have a 60-40 debt equity mix or 50-50, but they've got structures as to what they want their portfolio to look like. They tend to spend it when they get the money. And I believe one of the reasons that we have very low interest rates is they're not buying treasuries anymore, and they're not buying bonds anymore, but they're hiring people to go into the private debt market, trying to get an extra 0.25%. But if junk bonds are yielding 6, they're not coming anywhere near their actuarial assumptions. But the point is, we have a designated amount of money. General Motors and Ford haven't made money for the stockholders in 40 years, but they funded a pension plan, and the pension plan is now bigger than the market value of the company. It has been for 30 years. I've been tracking this for a long time. Well, if that money is moving out of the economic economy into the financial economy, and we are now awash in capital. Well, there's nothing to keep that capital from going poof if those prices come down. And that remains the risk. Everybody's aware of the risk. Nobody is able to predict at what point you go from a correction to in 87, it was mechanical. It went from, 10% correction triggered people selling, went to a 12 to a 15, and we lost 25% in 2 days. We no longer have that mechanical. But I have sat through pension trustee meetings when the market had gone down and the consultant says, your bonds are down, but your stocks are down more. You by your 60-40 designation, you should buy some stocks. And one of the trustees says, are you out of your mind? These things are killing us. I want the hell out of them. Well, if you get that, you get that final leg down in a overriding bear market. And I can't tell you if that will happen, but it's a risk. But we continue to move money out of the goods economy into the financial economy. Pension funds are a driver of that. I was on Squawk Box one morning, and he said, what do you worry about? I says, I don't worry about all the things we're talking about. The risks that you see coming means you're prepared for. It's the ones that you don't see coming that you're not prepared for that cost you big money. But one of my phrases, I don't know if we've got it on the stuff for what we call charts, Ron's charts 2022. But one of my maxims is when they change the rules a little, they change the game a lot. The next time you play Monopoly, instead of getting $200 when you pass go, get $100. Monopoly is an inflationary game, right? That $200 when you pass go feeds more and more money into the game, which is the only reason you'll pay more for the railroads at the end of the game than you pay up front. Now, the other properties, you build houses and hotels on, you improve them, but the railroads, you don't. Once you've got all four, you've got them. But the next time you play Monopoly, instead of pass and go with $200, pick $100. It cuts the inflation in half and tightens up the game big time. When they change the rules a little, they change the game a lot. And but the things that'll kill you, the assumptions you make won't kill you. It's the assumption behind the assumption. When everybody knows something and no longer questions it, that's what'll kill you. It's been a pleasure, Itai. Hope you enjoyed this.
Yes, this is a tremendous session. Thank you so much, and thank you for taking the time out of your busy schedule to be with us today.
I enjoyed it. Thank you.
Have a great day. Thanks.
Will do.